Kunal, you just kicked off this year's Morningstar Investment Conference. How does it feel?
It feels great because I can now sit back and be a fanboy.
You had a lot of us that were sitting there as fangirls and fanboys, and I was watching Twitter during your presentation, and one of the things that you touched on is actually the amount of 18 to 24-year-olds that go to Morningstar's website. And Twitter was like, wow, I didn't realize it was that many people.
Well, it's the changing face of the investor. I mean, you've seen the stats around engagement. Pandemic, I think, has changed who engages, and I think it's great because the earlier people get engaged with their investments and start thinking about saving money, putting things aside, I think it's good.
I'm speaking with Jeff Patak. He is the Chief Ratings Officer at Morningstar. Big job, lots of responsibilities. Tell us about the Globe rating system.
Yeah, the Globe rating system is a system that we use to denote a fund's level of material unmanaged ESG risk. And so essentially for those who have ESG as a primary objective, you can use the Globe to determine how well it is that fund is advancing those ESG objectives that you have. And so that's a rating that we introduced a few years ago and has become very popular in relatively short time.
Some of the aspects of your rating system now have a 10-year track record, correct?
That's right, yeah. So our analyst rating has a 10-year track record, and then of course the star rating predates it. It incepted in 2002 in its current form, and so there's quite a bit of track record under that. So yes, we've got a number of rating systems that have a good deal of track record under them.
Our first interview of the day with Yuban Kim. You just finished your presentation on digital trends. Tell me, how'd the presentation go?
I guess it went pretty well. It's my first time speaking at Morningstar conference, so it was a really great experience, and hopefully the audience would have found great value from our presentation.
Let's talk a little bit about your session. What did you present on?
So it was about how investors think about the digital trend in investing. And so with this rising popularity of the digital investing platforms, we wanted to understand who those investors are, as well as their needs, preferences, and also the obstacles that they are facing. And on top of that, we also wanted to see what important value-adding gap that advisors can fulfill that these trading platforms cannot. And lastly, we also looked into the innovative industry practices that these digital investing platforms are doing so that we can see, and then we looked into detail what kind of features investors like and don't like about them to see what kind of, to see what we as advisors would want to emulate or not build on. So those are kind of the overall theme of my session.
So I'm speaking with Bobby Blue, senior analyst. He just hosted a session. Bobby, what was the session about?
We had two really great allocators. So managers that invest both in equities and bonds, talking to them about where they're investing in the world. Obviously, a lot of market narratives out there right now. We tried to make sense of some of those and really dig into where they're positioning their really world allocation strategies right now around the world.
So where are the opportunities today around the world based on that session?
Well, they saw a couple different tracks. So really the narrative was it's not as bad as it looks. So obviously we've had a pretty sharp sell-off in some of the high-flying tech names, even some of the generals, call it the FANG stocks that have really carried the market the past few years. They're seeing opportunities in some of these names. They've come down quite a bit, but the businesses really haven't changed that much. So both Kate and David are starting to position their portfolios in some of these clear tech names that have really gotten beaten down. And on the flip side, on the fixed income part of their portfolio, they're seeing opportunities a little further out of the curve on the duration side. So while they're still a little bit underweight traditionally to where they might have been, call it 5 years ago, they are starting to see some opportunities. And David even mentioned that he's bought treasuries for the first time since 2018 in the portfolio. So lots of opportunities out there, despite some of the negative headlines.
On Morningstar's new robo-advisor landscape, super hot topic, Amy, and you guys actually just had a research paper coming out in April that has caught a lot of attention. So for those that haven't seen that research yet on the US robo-advisor landscape, what are some of those highlights?
Sure. So we looked at about 20 different providers of digital investment advice in the United States. So these are companies that are typically targeting individual investors with lower wealth levels who are newer to investing. And instead of a traditional financial advisor where you're sitting down with an advisor and talking about your goals and your portfolio, your investment progress, they are handling things more digitally. So you're filling out a survey online and answering a series of questions, which then they will use to kind of map you into one of at least 5 different portfolios with 5 different risk levels. And they are managing your portfolio algorithmically. And also, a lot of these providers have tools that you can use to track your progress over time or to track multiple goals, things like that. So it's still a relatively small area in terms of invested assets. It's about maybe 800 billion or so in the US, but it has been growing at a pretty rapid rate.
I'm speaking with Madeline Hume, analyst for Morningstar. We're going to talk crypto. What'd you talk about?
We talked about digital assets and whether or not they're more than just bits and bytes. We looked at the inner workings of blockchain technology and how, a simple cryptography problem became an international sensation with over $2 trillion in market capitalization and all the different steps along the way.
Yeah, a lot to talk about, a lot going on in the crypto markets today.
Yes, as we speak, things are going on. I had to check this morning what the valuation was before I gave my presentation because it changes so much day to day.
We have a pretty sophisticated audience of financial advisors. Some have been dipping their toe into the space. Some are still afraid of it. What do advisors need to be thinking about as it relates to crypto?
So Morningstar has been looking at cryptocurrency as an asset class for a little bit now, and it's evolved since it was founded and since we have meaningful performance data, which starts around 2015. What's interesting about cryptocurrencies, and everybody knows this, is that it's a very volatile asset class. It's highly concentrated in a few names, and we know what those names are. It's Bitcoin and Ethereum. But what people may not keep in mind is that the volatility of cryptocurrency is so huge that the only asset class that we see that has volatility anything like it is oil futures. And if the events unfolding in Europe are any indication, oil futures are probably not appropriate for your investment vehicles. And so we say that the same is true of cryptocurrency as well.
Yeah. All right, so let's talk about some of the hot topics today for financial advisors in this space. Let's start with Fidelity. So they've added the ability to allocate to Bitcoin in their 401k. What's your take?
At this point, the Fidelity announcement puts the cart before the horse. There are still a lot of investor protections that need to be worked out in cryptocurrency. And the DOL has not yet formed a position on whether or not cryptocurrencies belong in an investor's portfolio for retirement. Looking at the volatility of the asset class, just to put it in perspective, if you have a 60-40 portfolio and you invest 2% in Bitcoin, that contribution to volatility can rise over 50% of your portfolio. So Fidelity's 20% allocation ceiling seems a little bit generous to us. We'd probably put it at 0.
Yeah, I mean, there's no 20% allocation to anything in the alternative space with that type of risk profile in the volatility sphere, just because it's so unknown. Don't you think there's some liability for financial advisors as they look at leveraging that platform?
Absolutely. Well, and, for plan sponsors, there's a ton of liability. Fidelity themselves doesn't carry that liability. It's the employers. They're the ones that are going to be engaging with their investors in court. They're the ones that are going to be shouldering that responsibility. And there aren't a ton of examples in history of times where we've seen a single asset on a 401k menu. Normally, they're diversified investments with a ton of underlying securities. And so this is a bit of an anomaly in that regard.